Hey guys, Ken Musso here. Welcome back to my YouTube channel on Let's Invest and Trade Together. Today we're going to talk about, are we in a bubble, and how you can diversify your portfolio just in case. Let's get to it. There is no denying this is a valid concern with the NASDAQ, Dow, and S&P near their all-time highs pre-COVID. In some cases, the NASDAQ is even higher than it was back in February. Now, I want to share with you guys arguments both for a bubble and those that are even against it being a bubble, as well as share you my opinions and therefore allowing you guys to draw your own conclusions. Arguments for the bubble. Stimulus packages have injected trillions of dollars into the economy, putting money into mine as well as other people's pockets, whether it's through the stimulus paychecks, as well as even unemployment, where people were even making more money through unemployment than they were before they were working. Therefore, a lot of people have taken those dollars and put it into the stock market while at home, therefore artificially raising the stock market and all the levels. Fed monetary policy or quantitative easing has issued buybacks where the federal government is now printing money and therefore trying to create liquidity, which has also artificially elevated the market. Unemployment still within the double digits. Now it has improved faster than expected, but it's still relatively high. And of course, the fact that the market is back to record highs. Now for the counter arguments. Since the market is at an all-time high doesn't necessarily mean that we're in a bubble. The S&P 500, for example, has reached an all-time high at least once a month for the last 50 years on average. Back when I worked at Merrill Lynch, I would hear all the time from clients going, I'm worried that we're in a bubble, the market's about to crash because we're at an all-time high. So this argument or the news circulating a lot of sensation around this fact doesn't really hold a lot of water. Fundamentals have indeed shifted, and I do believe, in my opinion, the market does adequately reflect this as far as we see the winners as in big tech and some consumer discretionaries. And then we also see certain sectors like industrials and energy being completely leveled. PE ratios for a lot of these companies that are moving dramatically upwards are still within reasonable levels. And lastly, the economy, though still in shambles, is picking up faster both on job numbers as well as unemployment, faster than what even analysts had expected. So drawing conclusions from all of these factors and all these things and just putting those into perspective, my personal opinion now is I give it about a 60% chance of a market pullback. Now, I don't think as far as it's going to be a dramatic pullback as far as anything larger than a correction, which would be about 10%. But I do think it is reasonable that we could expect a correction, or we could even see a pause within the market where we just see kind of ups and downs, but stagnation. So the best way to prepare for this, if we have a market pullback, or if it's even something even more dramatic than that, or we have something that's able to pick up, best way to prepare yourself overall is to have a diversified portfolio. Now, covering thoroughly how to diversify a portfolio and various different strategies would take several days to be able to cover it and do it justice. So instead of going through all of that, I'll just take a little bit of time and giving you quick pointers on how to spread your eggs and put them in multiple baskets. Now, one of the ways that you can diversify is by having various different asset classes, such as cash, bonds, stocks, derivatives, and even commodities. Now, personally, I like to stick with stocks. So if you want to keep it simple like myself, there's 3 ways that you can look at stocks and make sure that you're diversified and making sure that you're not having too much correlations amongst the various different positions that you hold. And that is through the size, the style, and the sector of the investment. When choosing the size of your investment, there are small cap, mid cap, and large cap. General rule of thumb is the larger the capitalization of the company, the more conservative it is and less volatile, generally. The smaller the cap, the riskier and more volatile the stock. If you want to be a little bit more conservative, of course you want to stick with more blue chip and more established companies. In other words, larger capitalizations. If you want to be more speculative, by all means move towards more mid cap and small cap stocks. Style. There's 2 styles when it comes to stocks. There's value and there's growth. The difference between the two, value is one that takes its profits and pays you as a stockholder and owner of the company dividends. Growth does the opposite. They actually take the corporate profits, reinvest it in the company, and therefore focus on driving the value of the stock. Sector. There's 11 sectors within the stock market. Now, I don't have enough time or adequate time to cover each sector individually, but I'll have them displayed here on the screen. Now, general rule of thumb is there are cyclical, there are sensitive, and there are defensive type sectors or stocks within those sectors, and it's important to understand the difference between them. More conservative investors want to be heavier into more defensive type of sectors or stocks. People that want to be more middle of the road go into more cyclical sectors, and more aggressive investors want to lean more towards sensitive type of sectors like tech. Other general rules of thumbs. No more than 10% of your portfolio should go into one stock. No, by all means, this is just a rule of thumb. If you want to put more into a stock, by all means, feel free to do it. Just be cognizant that you are taking more risk. If you can't pick a stock in a very specific sector and you wish to invest in that sector, you may want to consider a SPDR ETF. There's also nothing wrong with keeping a portion of your portfolio in cash. In fact, a lot of professionals and fund managers do this, anywhere between 5 to 10%, and as much as even 40% of their portfolios are sometimes in cash. And then lastly, invest in companies that you know. I can't stress this enough. There's nothing worse than investing in something that you don't know, don't understand, and God knows it could be something that's just a pump and dump. Now that's it, folks. Hopefully you guys found the video useful and understanding maybe are we in a bubble or are we not? Let me know as far as your thoughts. And if you liked any of the tips or if there's any tips that I didn't cover, please feel free to share it in the comments field. Love to learn from anyone. And if you are wanting to become a part of a community that's all about sharing and learning together, I do have a Facebook group. We're very active. A lot of people are sharing their best practices and tips, sharing their investments, their strategies. Great way for beginners to learn. But if there's anything else that you guys wish to comment on, feel free to leave that down in the comments field. Give us a like, subscribe to the YouTube channel. But for now, we'll catch you guys next time.